Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Pulse Biosciences Inc. annual report. Pulse Biosciences Inc. offers a range of innovative medical solutions through its novel bioelectric medicine platform. The company's flagship product is the CellFX system, which provides a non-invasive treatment for benign skin lesions using nanosecond pulsed field ablation technology. In addition to the CellFX system, Pulse Biosciences also offers several other products and services that cater to various medical needs. These include the CellFX NSFA percutaneous electrode system for soft tissue ablation in surgical settings, as well as the CellFX NSFA cardiac clamp designed for use in treating atrial fibrillation, AF. The company's product lineup also includes the CellFX NSFA 360 degrees cardiac catheter, which enables circumferential ablation in a single treatment cycle. The nPulse console is another key offering from Pulse Biosciences, providing a software-enabled console-based platform that accommodates the clinical workflow preferred by physicians. This comprehensive range of products and services underscores the company's commitment to advancing bioelectric medicine and improving patient outcomes. The stock price of Pulse Biosciences, Inc., PLSE, has experienced an increase in the past year, despite some fluctuations. Several key events have contributed to this growth, demonstrating strong investor confidence. One significant factor was the announcement of clinical data from its nPulse cardiac catheter first-in-human feasibility study. The study showed successful treatment outcomes for atrial fibrillation in 150 patients, with rapid procedure times and minimal adverse effects. This news led to a significant rally, with the stock surging 51% in the week leading up to February 9, 2026. Additionally, the company's Cone 2025 earnings call highlighted its innovative efforts in nanosecond pulse field ablation technology and strategic expansion plans, contributing to investor confidence. The FDA IDE approval for nPulse AF ablation study trial was also a significant regulatory milestone that positively impacted the stock price. Furthermore, the broader healthcare and biotech sector momentum in January 2026 had a positive impact on Pulse Biosciences shares, with a 3.71% increase on January 26, 2026. The establishment of a new $60 million ATM program also provided financial flexibility for the company, viewed positively by investors. While the stock has experienced volatility, these key events represent periods of notable positive stock price movement, contributing to an impressive 141.88% return over the preceding year. Pulse Biosciences, Inc., market capitalization of $1 billion, is materially smaller than most of its industry peers of roughly $3 billion. Pulse Biosciences, Inc., trades at a higher price-to-book ratio of 18.02 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 13% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. If the business does not improve its revenue and generate positive cash flow, the company will continue to struggle to cover its cost and interest expenses. This combination makes the investment case highly unfavorable unless earning issue is addressed. On top of the cash-burning business, shareholders are consistently diluted. I may be wrong, but I would suggest to stay away from such investment for now. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the growth side, new product introductions such as the cardiac surgical clamp and N-Pulse cardiac catheter system are expected to drive revenue growth. Positive clinical study results, regulatory clearances, procedure adoption by target surgeons, and market share in relevant device markets also contribute to revenue growth. On the decline side, intense competition from established medical device companies is a significant driver of revenue decline. Government regulation, including clearance/approval pathways and regulatory controls, also contributes to revenue decline. Additionally, failure to raise additional capital, ongoing armed conflicts, increasing tariffs, reliance on a single family of products, and limited commercial history all negatively impact revenue growth. Furthermore, pricing pressure and failure to achieve expected procedure volumes are other drivers that contribute to revenue decline. These factors highlight the importance of strategic planning and adaptability in navigating the complex medical device market. By understanding these primary drivers, companies can make informed decisions to mitigate risks and capitalize on opportunities for growth. The net income of the company has been subject to significant fluctuations. Initially, it decreased due to continued operating losses and reliance on a single product line. This trend is expected to continue as profit margins remain low or negative until additional products are developed. However, there is uncertainty surrounding the future of net income, with potential for significant fluctuations and harm from inefficiencies, unanticipated costs, and manufacturing problems. The reasons behind these changes are multifaceted. The company's limited operating history, high upfront capital expenditures, and significant risk have contributed to its financial struggles. Additionally, reliance on a single product line has made the company vulnerable to market pressures. Rapid expansion, manufacturing problems, inadequate training of surgeons and staff, uncertainty in government reimbursement, and potential delays in manufacturing have also taken a toll on the company's net income. Profit margins have been affected by various factors, including increased administrative and operational infrastructure costs, failure to upgrade technical systems, higher production costs, and the need to reduce sales prices or fees. The company's reliance on contract manufacturers has also introduced risks related to quality control and regulatory compliance. Overall, the company's financial performance is precarious, with significant challenges ahead in terms of stabilizing net income and improving profit margins. The company's financial performance indicates a concerning trend of negative operating cash flow. According to the provided information, the net cash used in operating activities has been consistently negative over the past 2 years, with figures of $54.1 million in 2025 and $36.3 million in 2024. This suggests that the company is struggling to generate sufficient cash from its core operations, which can be a red flag for investors and stakeholders. The management of the company has outlined a clear strategy for its future growth, focusing on the treatment of atrial fibrillation, AF, as a key area of development. The company plans to leverage its NS-Fa energy and N-Pulse platform in this space, which is estimated to be a $3 billion addressable market within electrophysiology. To achieve this goal, the company will prioritize commercialization efforts, product development initiatives, and clinical and regulatory developments. In addition to AF treatment, the company also plans to pursue FDA approval for its cardiac surgery system as a treatment for AF and seek PMA approval for the N-Pulse catheter system in the U.S. The company may also explore partnership opportunities to develop additional applications for its NS-Fa ablation technology. Financially, the company expects to incur additional losses over the next several years due to continued investments in research and development. However, it believes that existing cash reserves will be sufficient to fund operating requirements for at least 12 months. The company plans to raise more capital soon through public or private equity offerings, debt financings, or revenue-generating collaborations. The management has also highlighted key risks and uncertainties, including uncertainty around technology adoption and revenue generation, the need for additional financing to sustain operations, and potential changes in the regulatory environment that could impact the company's business and results. The company's financial activities over the past year have been notable for their focus on share buybacks. Despite not paying out any dividends to shareholders, the company has made significant investments in purchasing back its own shares. This strategic move is likely aimed at reducing the number of outstanding shares and increasing the value of each remaining share. While some investors may be disappointed by the lack of dividend payments, the company's decision to buy back shares suggests a commitment to returning value to shareholders through alternative means. By doing so, the company has demonstrated its confidence in its financial position and its ability to make strategic investments that benefit its stakeholders. That concludes the financial summary for Pulse Biosciences Inc. Feel free to comment below, and I will be happy to answer them when possible.